Imagine this. You open your investment app, check your portfolio, and notice something shocking. The flashy tech stock you bought at a high price is sinking. But the boring company you almost ignored, the one selling paint, toothpaste, or soap, is steady, even growing. Why does this keep happening? Why do value stocks, the boring ones, often beat the market over time? By the end of this video, you'll not only understand why, but also know exactly how you can take advantage of it. And here's the twist. The reason value stocks outperform might completely change the way you look at investing forever. Number 1. What exactly are value stocks? Let's keep it simple. A value stock is a company whose share price is lower than what the business is actually worth. Investors call this being undervalued. Imagine you're at a garage sale. You find a designer jacket worth $200 selling for just $50. That's a value stock in action, a company selling for less than its true value. Famous investors like Warren Buffett built fortunes by hunting for these garage sale bargains in the stock market. For example, during the 2008 financial crisis, Buffett invested heavily in companies like Goldman Sachs and General Electric when their stock prices were beaten down, even though the businesses themselves were solid. Number 2. Why do value stocks get undervalued? Here's where psychology plays a huge role. Markets run on human emotions, fear, and greed. When a company faces bad news, its stock price often drops more than it should. People panic, sell quickly, and drive the price down. For example, think of airlines during the pandemic. Travel was halted, profits collapsed, and investors dumped airline stocks. But some investors noticed airlines weren't going extinct. People would eventually fly again. Those who bought undervalued airline stocks back then made huge gains when the world reopened. This is the secret. The crowd often overreacts, and value investors quietly wait, buying good businesses at cheap prices. Number 3. The power of mean reversion. Here's a simple truth. Stock prices don't stay disconnected from reality forever. Over time, they revert to the mean. That means if a good company's stock is unfairly punished, sooner or later, its price moves back toward its true value. Let's say a company earns $5 per share every year. If its stock falls to $20, that's a price-to-earnings ratio of just 4. Compare that to the market average of about 15 to 20. Eventually, investors notice the discount, buy in, and the stock rises. This is why patience pays. You're not betting on quick hype, but waiting for the math to catch up. Number 4. Dividends make a huge difference. Value stocks often belong to older, established companies that pay dividends. These are regular cash payments to shareholders. Think of Coca-Cola or Johnson & Johnson. While growth stocks reinvest profits to expand, value stocks share profits with you. Here's why it matters. Dividends give you steady returns, even if the stock price takes time to climb. For example, if you own a stock worth $100 that pays a $3 dividend every year, that's a 3% return just for holding. Over decades, reinvesting dividends compounds your wealth like magic. Fun fact: studies show that companies paying consistent dividends tend to outperform non-dividend payers in the long run. It's like getting paid to wait for your stock to rise. Number 5. Historical proof that value wins. Let's talk data. According to research from Nobel Prize winner Eugene Fama and his partner Kenneth, value stocks have historically outperformed growth stocks over long periods. From 1926 to today, value stocks in the USA have delivered higher average annual returns than growth stocks. Yes, growth stocks have moments of dominance, like during the tech boom or the recent decade of big tech. But when you zoom out, value keeps winning. Think of it as the tortoise versus the hare. Growth is flashy and fast, but value, slow and steady, wins the long race. Number 6. Why beginners often miss value stocks. Here's the painful truth. Beginners get distracted by hype. They see Tesla, Amazon, or the latest AI stock making headlines and feel like they must jump in. Meanwhile, value stocks don't make the news because they're not sexy. Who brags about owning a paint company? But here's the irony. By chasing hype, beginners often buy at the top. And by ignoring boring but undervalued businesses, they miss out on the real compounding power. The market rewards patience, not excitement. Think about this. In the dot-com bubble of the late 1990s, investors rushed into internet stocks. Many of those companies vanished. But value investors who stuck with solid businesses like Procter and Gamble or Johnson & Johnson came out ahead. Number 7. How to find value stocks step by step. Now you might be wondering, how do I actually spot a value stock? Let's break it down. Step 1. Look at the price-to-earnings ratio or PE ratio. If it's much lower than the market average, that's a clue. Step 2. Check the price-to-book ratio. If it's below 1, the stock may be trading for less than the company's actual assets. Step 3. Study dividends. If a company consistently pays and grows dividends, it's often a strong value candidate. Step 4. Look at debt. A good value stock shouldn't be drowning in debt. A strong balance sheet is key. Example: during the pandemic crash, investors who looked at PE ratios, book value, and dividend consistency could have spotted bargains in bank stocks. Many doubled in value once fear subsided. Number 8. The emotional challenge of value investing. Here's the hard part. Value investing isn't about instant gratification. Sometimes you'll buy a stock, and it stays cheap for months or even years before rising. This is where most beginners give up. Imagine planting a tree. You water it every week, but for months, it looks the same. Then one day, it shoots up. Value stocks are like that. You need patience and discipline to wait for the payoff. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." That's exactly what value investing is about. Number 9. When value stocks shine the most. Here's something fascinating. Value stocks often outperform right after market crashes. Why? Because fear pushes prices down way too far, creating bargains everywhere. After the 2008 crisis, banks, automakers, and industrial companies were selling for pennies on the dollar. Value investors who bought then saw massive returns over the next decade. The same thing happened after the 2020 crash. Investors who had the courage to buy undervalued energy and financial stocks made strong gains when the market recovered. So remember, downturns aren't just scary, they're golden opportunities for value investors. Number 10. Growth versus value. The ultimate showdown. Beginners often ask, which is better, growth or value? The truth is, both have their moments. Growth dominates during bull markets when optimism is high. Value dominates when reality sets in and hype fades. Think of growth stocks as high-speed sports cars. They're flashy, thrilling, and can get you far quickly, but they can also crash hard. Value stocks are like reliable pickup trucks. They may not excite you, but they'll keep running for decades. Smart investors often own both. But the reason value keeps beating the market long-term is because human psychology doesn't change. People will always overreact, creating opportunities for disciplined value hunters. Number 11. A real-life example of value beating the market. Let's look at Apple in the early 2000s. Believe it or not, Apple was once considered a value stock. Back in 2003, before the iPhone, Apple stock was trading cheaply because most people thought the company was struggling. Value investors who recognized Apple's hidden potential made fortunes when the stock took off. Another case is Ford Motor Company after the 2008 crisis. While competitors needed bailouts, Ford survived without one. Its stock had been beaten down, but those who saw its resilience made huge gains when it recovered. Stories like these prove that value investing isn't theory, it's real, and it works. Number 12. Value stocks protect you against inflation. When prices rise in the economy, your money loses value. But many value stocks are companies in industries like energy, consumer goods, or financials. These businesses often pass higher costs on to customers. That means they keep making profits, and you keep benefiting as a shareholder. For example, when oil prices surged, energy companies like ExxonMobil saw profits climb. Investors holding these stocks had a natural hedge against inflation eating away at their savings. Number 13. Value investing reduces risk through margin of safety. The idea of a margin of safety is simple. You buy a stock for less than it's worth, so even if things don't go perfectly, you have a cushion. It's like buying a house appraised at $300,000 for $200,000. Even if housing prices drop, you're still less likely to lose money. Benjamin Graham, the father of value investing, preached this idea. He believed that paying too much is the biggest danger in investing. By focusing on undervalued stocks, you give yourself protection. Number 14. Value stocks attract institutional money. Big players like pension funds, mutual funds, and insurance companies love stable, dividend-paying value stocks. These institutions control billions of dollars and prefer safe, predictable returns. When they pour money into value stocks, prices rise steadily over time. For beginners, this means you're riding alongside some of the smartest money managers in the world. Number 15. Value investing fits long-term retirement planning. Retirement is about steady growth in income, not chasing quick wins. Value stocks, with their dividends and stability, fit perfectly into a retirement portfolio. 4. Example: someone who bought Procter & Gamble stock 30 years ago has enjoyed decades of dividend checks, reinvested returns, and steady appreciation. That's the type of consistency retirees need. Number 16. Value stocks thrive in rising interest rate environments. When interest rates go up, growth stocks often fall because borrowing money gets more expensive. Value stocks, however, are usually mature companies with strong cash flow and less debt. They don't rely on cheap loans to grow. This is why, during periods when the Federal Reserve raises rates, value stocks tend to outperform. They're built to handle tougher financial conditions. Number 17. Value stocks benefit from market rotation. Markets move in cycles. Sometimes investors chase growth. Other times, they rotate back to value. This rotation happens when people realize they're overpaying for hype and return to solid fundamentals. For example, after the dot-com bubble burst in 2000, investors dumped overvalued tech stocks and rushed into undervalued industrials, energy, and financials. Value dominated for years afterward. Number 18. Value stocks represent real economy businesses. Many value companies produce things we all use every day: food, energy, medicine, clothing. These essentials don't go out of style. Even in tough times, people still eat, use electricity, and buy soap. That makes value stocks more resilient during recessions. For instance, while luxury retailers struggled during downturns, companies like Walmart or Kraft kept selling to millions. Number 19. Behavioral finance proves value works. Research in behavioral finance shows people consistently overpay for exciting stocks and underpay for boring ones. This psychological bias is exactly why value investing works. Think of it like movie tickets. Everyone rushes to see the blockbuster, even if it's overpriced, while the smaller movie with a great story is ignored. Later, critics and viewers realize the hidden gem was worth far more. Value investing takes advantage of this human blind spot. Number 20. Value stocks build generational wealth. Because value investing emphasizes patience and long-term growth, it's one of the best ways to pass wealth to future generations. Families who bought shares in companies like Johnson & Johnson decades ago still collect dividends today, often reinvested into even more shares. It's not just about making money for yourself. It's about creating a financial foundation your kids and grandkids can benefit from. So, why do value stocks beat the market? Because humans overreact. Because math eventually wins. Because dividends reward patience. And because history shows that boring businesses often bring extraordinary wealth. If you remember just one thing from this video, let it be this: you don't need to chase hype to win. Sometimes, the slow, steady, undervalued company in the corner ends up being the star of the show. Now here's my question for you. Would you rather invest in a flashy growth stock that could double quickly but also crash just as fast, or a reliable value stock that grows slowly but steadily, paying you dividends along the way?